All right, here's the agenda. Got some open networking. Capital Stacks is the education bit for this month. It's going to be an awesome lesson presented by Duke. If you are interested in Capital Stacks, we can do some breakout rooms. We got a bit of a deal announcement in the works, and then our normal book giveaway and some more networking. All right, let's get into it.
All right. So the capital stack, this is traditionally how institutional investors look at deal structures. So the general gist of the capital stack is as you go higher in a stack, you're increasing your risk, but you're also increasing your reward. And as you go lower in the stack, you're increasing your priority. So in this example, it's a traditional syndication model. You have senior debt, let's say 75% LTC, and then the rest of it is equity. And of the equity, you might have like a dual class structure like this, where you have A1 that's preferred equity, say target 10% cash on cash, and then A2 would be the common equity, target 2x equity multiple over 5 years. And then the GP co-invest, which is typically at least 10% of the equity portion. So the higher you go in the stack, the higher the risk, right? So GP is the highest risk because you have to put up the EMD, all the due diligence costs upfront, and you get reimbursed later if you're successful in the raise. But then, there's also a higher reward from that. Okay, so the waterfall. So assuming that same deal structure, for that one, say like you have the cash flow waterfall, 100% to the A1 LPs until you meet that 10% preferred return hurdle. And then anything in excess of that will waterfall down to the next level. So that one could be split, say like 75-25, A2, which is still LP, and then the 25% to the GP. And then on the refinance, you could have 100% return initial capital to the A1 first, and then their 10% preferred return if that's not already previously met by the cash flow. And then the remainder split 75-25 LP GP. And then on the sale, you could have 100% return initial capital if you didn't already accomplish that in the refi, 10% preferred return, and the return of initial capital for the A2, and then whatever profits remaining, you would split that 75-25 between the LP and GP. All right, so that's the traditional syndication model.
We got like 20 questions off what just happened.
Okay.
At least 20 questions.
Mama, right, so come here.
What was that? Anyway, let's go back to the first one. The first return or capital stack. Before we get into the return of capital. So as we're here, a couple questions I'm going to ask you if I'm sitting across the table. So if I'm looking at this, where am I in line to get my return, my payment?
So
like,
what
options do I have?
A1 or A2?
Okay, and then so if I'm higher in the stack, what questions should I ask, or how should I evaluate that risk, and what should I be looking at as far as returns as I'm evaluating my placement in the stack?
So as you go higher in the stack, you should expect a higher return because you're taking more risk because the priority is lower in the stack. So the senior debt is paid first, and then the preferred equity, and then the common equity. So as you go higher in the stack, you expect a higher return because you're taking a bigger risk.
Got it. And then where do things like mezzanine debt in those type of debt structures fall in line in this? Like where would that be?
If you took mezzanine debt, that would be between the senior debt and the A1 preferred equity.
Okay. So like mezzanine debt's almost like preferred equity, right? Like except that it's just not in the equity, but it's almost like the same thing.
Yeah, and you can have both. You can have a senior debt, 65%, say, and then 10% mezzanine debt, and then the same structure above that.
Got it. So the biggest takeaway of this is just if you're an investor, or if you're structuring these, you want to make sure wherever you're at in this stack, it's appropriate. The returns are appropriate for the amount of risk that you're incurring. Is one of the big takeaways from this model here. Cool.
Yeah, and one comment on the preferred equity is the reason that you're willing to accept a lower return overall, like just 10% versus say like 15%, 20%, is because you have higher priority. So your basis is actually lower than 100% because you get paid before the other investors.
Correct. And in most deals that accrues as well, right? So if like 1 month it's like 8%, and the next month that 2% will carry over. It's an important thing if you're going to be doing some kind of preferred equity, to be asking if you're on an accrual or not. That's a big one. All
Yep.
right. Cool. Thanks for explaining.
All right. So that's one model. The second kind of common model we've seen is this return of capital model. And the focus on this one is the refi. So as opposed to in traditional syndication model, you don't necessarily underwrite the refi. You just assume a sale in say 5 years. But in the return of capital model, you're focused on trying to return the capital to investors as quickly as possible so that you can increase the IRR, because IRR takes time value of money into account. So the earlier you get your capital, the higher the IRR. All right, so in this example, we have say 80% senior debt, and then the rest is equity. In this case, it's a single class, so there's no A1 or A2, it's just one class. And the terms on this one would be a 10% preferred return, so similar to the A1 in the traditional syndication model. But in this case, it's a little bit different because the focus is to try to just return the capital at refinance to the LPs. And then once that hurdle is met, then upon refinance, then the split is 70-30. So 30% equity to the LPs and then 70% to the GP. But the key with this is that after the refinance, if you're successful in the model, then you should have returned all the capital to the LPs, and therefore LPs are just enjoying infinite returns because they have no more cash basis in the deal. All right. Any questions, Vince?
So if I was putting together a deal and I am trying to figure out which one of these to go with, either the traditional model or the return of capital model, who am I looking for as far as when I'm looking at my network and my potential investors, my friends, my family, my circle of potential investors? Like what kind of questions would I ask to figure out which one of these models I'm going to go with?
So I think the return of capital model fits the investor that wants velocity. So that wants speed in terms of the movement of the capital. Because ideally, if you execute this well, you should be out of there in like 18 to 24 months as far as the refi. And so therefore, you get your capital back faster, and then you can then reinvest more into future deals. So that's the kind of investor that would be more inclined for the return of capital model. Whereas in the traditional syndication model, it kind of favors the more traditional growth, well, at least for the A2, the traditional growth investor that's willing to wait a longer time for a potentially higher equity multiple. But like if you have to wait longer, that means it's higher risk too, right? So like time is a key factor in evaluating the risk between the two models.
Yep. And then also like tax benefits too, right? I would imagine the traditional model will probably have better tax benefits as well. Usually I would think so, just because you're getting a cost seg and you can spread it out over some years versus all at once.
Yep. All right. So the waterfall for the return of capital model, for example, could look like this, where you have a 10% preferred return to the LPs and then the remainder to GP during the cash flow period. And then at refinance, 100% return in initial capital. So that's the priority, to try to return all the capital to LPs as quickly as possible. The 10% catch up. And then after that is the 30-70 split. And then upon sale, similar structure. So 100% return if this is already happening at the refinance stage, and 10% preferred return, and then the 30-70 split again on the profits. All right, any questions?
Hey, sorry. Yeah, I got one. So is this the model you use for all of your LPs, or is it just like specific to how much they're putting in? Like what makes you choose the 30/70 versus any other percentage?
Oh, it's just based on the underwriting. So like looking at the returns and the deal. So like this type of structure doesn't fit every deal, right? Like you have to have quite a bit of meat on the bone, like kind of wholesale prices, like true off market type of stuff, where you're getting a significant discount, where you're pretty sure that you can hit that refi um, because of the basis that's coming in. So, you know, like that's one example where you might use this model.
Yeah, this deal is pretty much banking on that refi. Like with a high cash out refi. So you're not going to want to really do this on like some kind of stabilized, stabilized property that, a light value add or something like that. It probably wouldn't work that well.
Yep.
So the other model is a lot more common. The traditional model is a lot more common.
Hence traditional.
Hence. Good question.
All right. If no other questions, then we'll move on to the next segment.
There's got to be at least one question. One more question.
Duke, this is Tyler. I got a question. So is it only on the return of capital model where I guess the capital is returned to the LPs prior to the GP taking returns? I thought even in the traditional structure, the main goal would be to return the capital to the LPs. Is that not the case?
Oh no, it's not mutually exclusive. So yeah, like you're completely right. It's yeah, I mean it's in here. So go back to that. Yeah, so in this dual class structure, it's priorities A1 return capital, and then A1 10% preferred return, and then so the priority is always to return the capital.
Sorry.
Yeah.
Just chiming in too. With in the refinance, does that mean the A2 doesn't get their capital returned if there's not enough?
Also, so in this particular example, like I mean, you can structure a deal however you want, right? But like in this example, it's 75-25 split.
So if the 75 didn't cover their return, then they wouldn't get their full return, but initial return.
Yeah, then they would still have a basis remaining, and then like at the sale, that's when they would get the remainder at this stage.
Okay.
I see. Yeah, I guess I was thrown off a little bit by the cash flow block where LP A2 would get 75, GP gets 25. Yeah, I honestly thought it was GP would get their cut after LP A2 would get their capital return, but
because we're sharing, right? So we're in that deal together. So we're both sharing that equity basis. So yeah, the A2s would get whatever they're prorated, their 75% at the refi, but whatever their cost basis is left, to say if they have 75 grand and there's a 25 and we got 100 grand back, their basis was 75%, they would get 75 grand back and that they would still have a 25% basis in the deal.
Got it. Okay.
So which would make their cash flow wouldn't really change because we don't have, or normally there's more waterfalls on, or well, not waterfalls, hurdles, right? So then you can add more hurdles to this. A lot of people do. So like say like this after a refinance, the split still could be 75-25. So even though your cost basis in that deal is a lot lower, you're still getting 75% of all the cash flows into perpetuity. Unless the deal would have something in there where it would be after a refinance or after this hurdle, maybe it would go to like 50-50 or 60-40. And you see that sometimes too. But usually a lot of people just leave it alone. So you would get back a huge chunk of whatever you put in at the refinance, but your cash flow and your percentage of equity, that percentage doesn't change.
Got it.
So that's when your ROI starts like getting much higher.
Yeah, because your basis is much lower after refinance. Even if it's not zero, like your cash on cash is like ridiculously higher. because
Yeah.
basis is so much lower.
Yeah, because you're still getting 75%.
Got it.
Yeah.
Okay.
So, but
thanks.
that is a good question, because if you're looking at other deals, they might have it in there where after a capital event, like a refinance, the equity will split. The equity splits differently. So it'd be like
Yeah.
before refinance 75-25, and then after refinance or after they hit this certain hurdle, it might go to 60-40 or 50-50 or something like that. So that's something you want to look out for. Not saying it's bad. It's just you want to be aware of that. So you're not expecting, a 75 and then a capital event happens and all of a sudden you get 50%. So like I said, it's not bad. You just got to make sure you ask those questions if you come across that.
Got it. Thanks.
You guys.
Good.
Yeah, great questions. Any other questions before we move on?